This presentation is devoted to Chapter 3 of the book Actuarial Foundations for Life and Health Insurance, entitled Insurance on Joint Lives. The objective is to move from the classical actuarial treatment of a single insured life to contracts written on two lives. The chapter uses the example of a married couple with a husband and a wife, because this is the natural setting for many practical products: survivor annuities, reversionary pensions, last survivor annuities, and borrower insurance. The key actuarial issue is that the relevant cash flows no longer depend only on the lifetime of one individual. They depend on the order of deaths, on the time of the first death, and on the time of the second death. The chapter therefore introduces a multi-state approach that follows the history of the couple over time. A central message is that marital status may affect mortality, especially after bereavement. Ignoring this effect is equivalent in the model to assuming independence between the two lifetimes. The presentation will show why this simplification is convenient, but often not conceptually satisfactory for pricing and reserving joint life products. We begin with an overview of the chapter. The first part explains why insurance contracts on two lives require a richer description than the single life model developed earlier. The second part introduces the states of the model and the forces of mortality by marital status. The third part studies the actuarial probabilities that drive pricing: survival until the first death, survival until the second death, and the marginal survival of each spouse. The fourth part explains the dependence structure created by the widowhood effect. The last part applies these tools to premiums, reserves, widows' pensions, and borrower insurance. This chapter extends the single life framework to contracts covering two insured lives, with the married couple used as the reference example. This choice is not restrictive for the main ideas, because most of the formulas depend on whether both lives are present, whether one spouse has died, and whether the contract continues after the first death. The central modeling device is a four-state process. In the initial state, both spouses are alive. After the first death, the process moves either to the state where the wife survives her husband, or to the state where the husband survives his wife. The final state is reached after the second death. This structure is essential for contracts that continue after the first death, such as survivor annuities. Mortality intensities are allowed to depend on age and marital status. This is how the model incorporates the widowhood effect, namely the empirical observation that mortality may rise after the loss of a spouse. The chapter then shows that this mechanism creates positive dependence between spouses' lifetimes. In particular, joint survival can be larger than what would be obtained under independence. This matters for pricing, last survivor benefits, first death benefits, widows' pensions, and borrower insurance do not react in the same direction when dependence is introduced. The chapter therefore provides both a modeling framework and an actuarial interpretation of the consequences of marital status-dependent mortality. The next section introduces the motivation and the model structure. The guiding question is simple: what must be added to the single life model when the contract is written on two lives? A benefit payable at the first death only requires us to identify which spouse dies first. A benefit payable after the first death, however, requires us to follow the surviving spouse until the second death. This is why the chapter moves from a three-state representation to a four-state representation. The transition is not just a technical refinement, it changes the way probabilities, reserves, and premiums are computed. A contract paying a lump sum at the first death can be represented with a relatively simple structure. Starting from the state in which both spouses are alive, the only relevant event is whether the husband dies first or the wife dies first. Once the first death has occurred, the contractual event has been triggered and the product may terminate. This is why the techniques used for competing causes of exit are sufficient in that restricted case. The situation changes as soon as the insurer promises annuity benefits to the surviving spouse. The contract then continues after the first death, and the duration of payments depends on the remaining lifetime of the survivor. The model must therefore include the state where both spouses are deceased, because the second death determines the end of the survivor benefit. The chapter emphasizes that this is not only a question of adding a state. The death of one spouse may affect the mortality of the other, a phenomenon widely discussed in demographic and medical studies under the name widowhood effect. If the survivor's mortality increases after bereavement, marital status becomes part of the risk description. In practice, actuaries often assume that mortality does not depend on marital status because it greatly simplifies the mathematical analysis. The chapter makes explicit what this assumption means. It removes the dependence mechanism between the two insured lifetimes and leads to the independence benchmark. The Richer model is therefore introduced to avoid treating this simplifying convention as if it were a realistic description of the risk. The figure summarizes the four-state Markov model used throughout the chapter. The process starts in state E0, where both spouses are alive. From this state, two transitions are possible. If the husband dies first, the process moves to state E1, where the wife is alive as a widow. If the wife dies first, it moves to state E2, where the husband is alive as a widower. From each of these survivor states, one further transition leads to state E3, where both spouses are deceased. A direct transition from the initial state to the final state is excluded, so simultaneous death is ruled out. The chapter notes that adding such a transition would not change the main analysis, but excluding it keeps the presentation clearer. This diagram is important because each transition is associated with a different force of mortality and possibly a different benefit. A first death benefit depends on the transition out of E0. A survivor annuity depends on the time spent in E1 or E2. A second death benefit depends on the transition into E3. The model therefore separates three actuarial questions that are often mixed together in simpler approaches. Who dies first? How long does the survivor live? And when do all contractual payments stop? It also makes clear why marital status matters. The mortality intensity of a person in state E0 is that of a married individual, whereas the mortality intensity in E1 or A2 is that of a widow or widower. We now turn to mortality by marital status. The model does not use a single mortality curve for each sex. Instead, it distinguishes the mortality of a married man from the mortality of a widower, and the mortality of a married woman from the mortality of a widow. This distinction is the technical expression of the widowhood effect. The forces introduced in the next slide are transition intensities of the four-state process. Once these intensities are known, survival probabilities and actuarial present values can be derived by integration over time. The slide defines the four forces of mortality that govern the transitions of the model. The mortality of a married man at age X plus T is the instantaneous rate of transition from the state where both spouses are alive to the state where the wife survives her husband. Symmetrically, the mortality of a married woman at age Y plus T is the instantaneous rate of transition from the initial state to the state where the husband survives his wife. After the first death, the relevant intensities change. The mortality of a widow at age Y plus T is the instantaneous rate of transition from the state where the wife is alive alone to the final state. The mortality of a widower at age X plus T is the analogous rate from the state where the husband is alive alone to the final state. The notation H and W used in the slide identifies the husband and the wife, while M stands for married and V for widowed. The chapter makes an important modeling restriction here. These rates depend on the individual's age and marital status, but not on the spouse's age and not on the time elapsed since marriage or since bereavement. This keeps the model Markovian. Once the current state and current ages are known, the future transition rates are known. The restriction is also a limitation. In reality, the excess mortality following bereavement may be strongest immediately after the spouse's death and may decline over time. The chapter returns to this point in the conclusion as a motivation for semi-Markov extensions. The next section derives the main probabilities from the forces of mortality. These probabilities determine the value of joint life contracts. The analysis starts with the first death and the second death, because most products written on two lives are triggered by one of these events. It then considers the marginal survival of each spouse, which is more subtle than in the single life case because the survival law of one person may depend on whether the other spouse has died. Finally, the section translates these probability calculations into a dependent statement. The two lifetimes are not independent when mortality depends on marital status. This dependence has a clear actuarial interpretation and will later affect premium comparisons. The first expression on the slide gives the probability that the first death occurs after time t. This is simply the probability that both spouses are still alive at time t, or equivalently that the process is still in the initial state. Because there are two possible ways to leave this state, the cumulative hazard is the sum of the married mortality intensities of the husband and the wife. The chapter derives this result by looking at a very short time interval. Over such an interval, the probability of leaving the initial state is approximately the sum of the two instantaneous death rates. This leads to an exponential survival expression, exactly as in the single life case, but with two intensities instead of one. The second expression concerns survival until the second death. This probability is the probability that at least one spouse is alive at time t. It includes three possible states: both alive, wife alive alone, or husband alive alone. Unlike the first death probability, it does not reduce to a simple product. The integral terms decompose the scenario according to the time of the first death. For example, if the husband dies at time tau, both spouses must have survived up to tau. The husband must die at that time, and then the widow must survive from tau to t under widow mortality. The other integral is symmetric and corresponds to the wife dying first. This decomposition is the core of the actuarial valuation of survivor benefits. The slide focuses on the survival probability of each spouse considered separately. At first sight, one might expect the husband's survival probability to depend only on his age and on the male mortality table. In this model, that intuition is incomplete. At policy inception, the husband is alive and married. If his wife dies before time t, he continues as a widower, and his future mortality may change. The husband's survival probability is therefore the sum of two probabilities: the probability that both spouses are alive at time t, and the probability that the wife has died first while the husband has survived as a widower until t. The expression displayed on the slide makes this decomposition explicit by conditioning on the time of the wife's death. The same reasoning applies to the wife. Her survival probability is the probability of remaining in the initial state plus the probability of being in the state where she survives her husband. If widowed mortality is higher than married mortality, survival after bereavement is lower than it would have been under married mortality. Consequently, each individual survival probability is bounded above by the corresponding married survival probability. This is one of the subtle points of the chapter. Even the marginal survival of one spouse depends on the couple structure. The age and mortality of the other spouse influence the probability that the individual enters widowed status before the horizon considered. The inequality on the slide expresses positive quadrant dependence between the remaining lifetimes of the husband and the wife. In words, the probability that both lifetimes exceed two given thresholds is at least as large as the product of the two marginal survival probabilities. This means that joint survival is larger than what would be obtained under independence. The intuition follows from the widowhood effect. If one spouse has survived for a long time, it is more likely that the other spouse has not entered the widowed state early and therefore has not been exposed for a long period to aggravated widowed mortality. Survival of one spouse is thus favorable information about the survival prospects of the other. The chapter also gives equivalent interpretations in terms of conditional probabilities. For example, conditional on the husband being alive at a given time, the probability that the wife survives beyond another time is at least as large as her unconditional survival probability. This is not merely a statement about a positive covariance between lifetimes. Positive quadrant dependence is stronger and more robust because it remains valid for increasing transformations of the lifetimes. The dependence is generated internally by the transition structure and by the difference between married and widowed mortality. When the mortality rates are the same in married and widowed states, the inequality becomes an equality and the independence benchmark is recovered. The two inequalities on the slide are the Frechet bounds applied to joint survival and joint death. They are purely probabilistic bounds and require only the marginal probabilities. The first bound concerns the probability that both spouses are alive at time t. this probability cannot exceed the smaller of the two marginal survival probabilities, and it cannot be lower than the excess of their sum over 1 when this excess is positive. The second bound applies the same idea to the probability that both spouses have died before time t. These bounds are useful because they describe the largest possible range for joint probabilities when the marginal laws are fixed but the dependent structure is unknown. In the chapter, they provide a benchmark for the pricing impact of deviations from independence. They also help interpret the position of the Markov model relative to the independence case. Under the widowhood effect, the probability that both spouses are alive tends to be larger than the independent product, while the probability that both have died can also exceed the independent benchmark in a way that affects second death products. For an actuary, the Frechet bounds are not a model in themselves. They are a diagnostic tool. They show how much model risk may be attached to the dependence assumption when pricing joint life annuities, survivor pensions, or benefits linked to the first or second death. We now move from probabilities to actuarial values. Once the transition probabilities have been identified, the same logic as in single life insurance can be applied. Expected present values of benefits and premiums are calculated, and mathematical reserves are defined as prospective differences between future liabilities and future premiums. The difference is that the current state of the couple matters. Being in the initial state, in the widow state, or in the widower state leads to different future cash flows, and therefore to different reserves. This section translates the four-state model into the language of premiums, benefits, annuity payments, and reserves. The cash flow description follows the structure of the four-state process. Premiums may be paid while the couple is in state E0, E1, or E2, and these payments are represented by 3 cumulative premium functions. This allows the contract to specify different premium rules depending on whether both spouses are alive or only one spouse remains alive. Death benefits are attached to transitions. A payment associated with the death of the husband while both spouses are alive is not the same contractual event as a payment associated with the death of the widow. The notation therefore distinguishes benefits linked to the 2 first death transitions and to the 2 second death transitions. Annuity benefits are represented by cumulative payment functions in the living state. A last survivor annuity pays while the process is in any state except the final state, whereas a survivor annuity pays only in one of the 2 survivor states. The expected present value of benefits is obtained by integrating each payment over the probability of occupying the relevant state and by adding the discounted value of transition benefits weighted by the appropriate mortality intensity. The reserve calculation is also state dependent. If both spouses are alive at time t, the reserve must include all possible future paths. If the wife is already a widow, only the future transition from E1 to E3 remains relevant. If the husband is a widower, the analogous reserve applies in state E2. This explains why the model requires 3 reserves rather than a single reserve function. The slide summarizes the main products that can be valued within the 4-state framework. A deferred capital may be payable only if both spouses are alive at maturity, or alternatively if at least one spouse is still alive. These 2 cases correspond to first death and last survivor logic, and therefore use different survival probabilities. Immediate annuities can also be written in 2 forms. A last survivor annuity pays as long as at least one spouse is alive, so its value is based on the probability of not yet being in the final state at each payment date. A first death annuity pays only while both spouses are alive, so it stops at the first death and is based on joint survival in the initial state. The widow's pension is particularly important. It pays after the husband's death and before the widow's death. Its actuarial value is therefore the discounted expected time spent in state E1 at annual payment dates. The expression on the slide rewrites that probability as the wife's marginal survival probability minus the probability that both spouses are alive. This interpretation is useful. The widow receives the pension precisely when she is alive, but the husband is not. The chapter also discusses reduced annuities after the first death, using reversion percentages paid to the surviving spouse. In this way, many classical joint life products become combinations of the probabilities of occupying states 0, A1, and E2. This slide explains the actuarial meaning of the independence assumption. If the mortality of a man is the same whether he is married or widowed, and if the mortality of a woman is the same whether she is married or widowed, then marital status no longer carries mortality information. In that special case, the marginal survival laws are unaffected by the spouse's life history, and joint survival is simply the product of the two marginal survival probabilities. The remaining lifetimes are then independent. The chapter uses the superscript for quantities calculated under this benchmark. When the widowhood effect is present, this benchmark is no longer valid, and the direction of the pricing bias depends on the product. Positive quadrant dependence increases the probability that both spouses are alive together, which tends to increase last survivor values relative to the independence formula. By contrast, it decreases the expected duration of first death annuities relative to independence, because these annuities stop when the first death occurs and joint survival behaves differently. For widows' pensions, the independence assumption may overstate the premium. The reason is that the Markov model with aggravated widowed mortality tends to keep the couple longer in the initial state and shortens the period spent in the widow state. The pension is paid during that widow state, so its expected present value falls. This is a key practical conclusion. Independence is not always conservative. The figure illustrates the pricing consequences for a widow's pension. It compares the premium obtained under the Markov model with the premium obtained under independence and with the Frechet lower and upper bounds. 3 age configurations are displayed. In the first panel, the husband and the wife have the same age at policy inception. In the second, the wife is 5 years older than the husband. In the third, the wife is 5 years younger. Across these cases, the Markov premium lies below the independence benchmark. This is the numerical confirmation of the theoretical discussion. When widowhood increases mortality, the expected duration of the widow's pension is reduced. The chapter reports that, in this illustration based on Belgian estimates by Denuit and Cornet, the four-state model gives premiums around 90% of those obtained under independence. The figure also shows that the Markov values remain inside the Frechet bounds, as they should, since those bounds delimit the range of possible values compatible with the fixed marginal tables. The shape of the curves is also informative. Premiums rise with age at first because the probability of entering the widow state becomes more substantial, and then decline at older ages because the remaining duration of payments becomes shorter. The relative position of the age difference panels reflects the interaction between the probability that the husband dies first and the expected remaining lifetime of the widow. This graph is therefore not only a numerical illustration, it shows how dependence, age difference, and mortality aggravation combine in survivor benefit pricing. The final technical section illustrates how the mortality inputs of the model can be estimated and how the framework applies to a concrete insurance product. The chapter uses data by sex, age, and marital status in the French population for 2002. The objective is to construct separate mortality rates for married men, widowers, married women, and widows. This requires more care than estimating a standard mortality table, because people may leave a marital status not only by death, but also through widowhood, divorce, or remarriage. The section then uses the estimated rates in a borrower insurance example, which is a practically important product for couples taking out a mortgage. The empirical part starts from French data giving populations and deaths by sex, age, and marital status. The crude estimate of each force of mortality follows the same principle as in the single life chapter. The number of deaths is divided by the exposure to risk. The difficulty is the construction of the exposure. For married men, for example, exposure must be reduced not only by deaths among married men, but also by cases where the wife dies and the man becomes a widower, and by divorces. If these exits were ignored, the denominator would be wrong and the estimated married mortality rates would be distorted. For widows and widowers, remarriage must also be accounted for, because remarriage removes the individual from the widowed state. Under the assumption of piecewise constant transition rates over each year of age, the chapter gives an exposure approximation consistent with the earlier formula for exposure to risk. It also notes that this approximation is close to the simpler mid-year transition approximation. The crude rates reported in Table 3.1 are irregular, especially for widows and widowers, because the number of observations in these statuses is smaller and more volatile at young ages. The chapter therefore smooths the crude rates using Poisson regression following the methodology introduced in Chapter 1. The smoothed curves show high mortality for young widowed individuals, which may reflect strong short-term bereavement effects, although the available data do not allow that duration effect to be tested directly. The borrower insurance example shows how the model is used for a contract linked to a loan. The couple borrows €100,000 and repays the debt over 20 years through constant annual payments. The annual loan rate is 5%, which gives an annuity amount of €8,024.26. If one spouse dies during a policy year, the insurer repays the outstanding balance at the end of that year, releasing the surviving spouse from the debt. Equation 3.3 gives the pure single premium. In words, it sums over all years of the loan the discounted outstanding balance multiplied by the probability that both spouses have survived up to the beginning of the year and that at least one death occurs during the year. The outstanding balance decreases over time, while the probability of death increases with age, so the premium combines a financial amortization effect with a mortality effect. For a man aged 30, a woman of the same age, and a technical interest rate of 3.5%, the chapter obtains a pure single premium of €1,460.83. The qualitative comparison with independence is also important. Because the four-state model uses lower married mortality rates for married men and women, the couple tends to remain longer in the initial state. This delays potential insurer payments and therefore lowers the single premium relative to the classical independence calculation. If premiums are paid periodically, the effect is reinforced because the couple also tends to continue paying premiums for a longer period. The conclusion brings together the main actuarial lessons of the chapter. The four-state model is useful because it links a clear demographic mechanism, the widowhood effect, to the valuation of standard products. It also identifies a limitation of the Markov specification. The chapter provides a coherent framework for pricing and reserving insurance products written on two lives when mortality depends on marital status. The four-state model distinguishes the first death, the survivor period, and the second death, which makes it suitable for annuities with reversion, survivor pensions, and borrower insurance. The widowhood effect is the central modeling feature. It modifies individual survival laws, generates positive dependence between the remaining lifetimes of the spouses, and changes the sign and size of the difference between Markov premiums and independence premiums. The chapter also shows how Frechet bounds and independence benchmarks can be used together. Frechet bounds describe the range of possible values when only marginal probabilities are fixed, while the independence value gives a convenient but potentially misleading reference point. The numerical illustrations confirm that the choice of dependence model can have a material effect, especially for survivor benefits. Finally, the chapter points toward an important extension. If the mortality of widows and widowers is highest immediately after bereavement and then decreases, a purely Markov model is too restrictive. A semi-Markov model, where transition rates depend on the duration already spent in the widowed state, would better reflect the empirical evidence.